Well, good morning, everybody, and thanks for attending the summer Esop Sofa. And we're going to be talking today on the subject of EGM, AGMs, remuneration policies, and share plan design. And you'll be hearing from our two speakers today, who are Carla Walsham from Tapestry and Gary Faraday from Deloitte Reward. My name is Robert Pay, and I'm the chairman of the Esop Centre, and it's my pleasure to be able to chair this event today. But I can only do that thanks to the generosity of the members of the Esop Centre who sponsor it, and also the FS Club. It's particularly with thanks to the sponsors that we're able to range so freely across the subjects of financial services, technology, and of course today remuneration. Before we get underway, some housekeeping notes. Um, I'm going to be chairing today, and we're going to let the panelists speak for a few minutes each to state their positions before we move into sort of panel mode. This webinar is being recorded and will be available for download in about 48 hours time. So after the panelists have spoken and they've had a debate with each other, we're going to have about 20 minutes of Q&A. So please get your questions ready. There's a little chat facility at the side where you should be entering those. And then I'll feed those into the conversation. So without further ado, I'm going to hand over to our panelists, and we're going to be starting with Gary, who will talk about remuneration and AGMs and what he's seeing in the marketplace. Thanks, Gary.
Thank you very much, Robert, and good morning, everyone on the webinar. So before I talk about the 2025 AGM, I'm just going to kind of rewind slightly to the 2024 AGM. And that's really where we saw the kind of first green shoots in terms of kind of changes, shifts in remuneration policy. And ultimately that started with a call from the Capital Markets Innovation Task Force asking for a review of pay governance in terms of how we can make the UK market more competitive, more attractive. And kind of over the last 12 to 18 months, we've seen kind of various signs in terms of a more open UK market and a more kind of acceptance for organisations to review their remuneration policies from first principles, taking into account business strategy, taking into account talent strategy, and also talent needs. So a couple of examples. So back in October 24, we saw the publication of the latest Investment Association remuneration guidance, and kind of whilst a number of the features remain the same, what we have seen is a shift in the tone, and definitely kind of supporting a greater willingness for companies to review policies on a case by case basis, and shareholders to also kind of look at them on a case by case basis. So positive change there. And then kind of a second example is the relaxation of the pay governance features within the UK banking sector, so around kind of bonus deferral for example. So with that backdrop, in terms of 2025 AGM season, kind of I'd like to just talk through three key trends that certainly I've been seeing across kind of clients and the market more broadly. So first of all, increases in quantum, so particularly LTIP opportunities, and this has been most true for our kind of largest global organisations, so kind of those across the kind of FTSE 30, FTSE 100. And the kind of case there has very much been around kind of ensuring that the package for the CEO, kind of other executive directors, is competitive and well placed to attract talent when competing on a kind of a global market base, and particularly kind of US focus there too. So just to bring that to life a little bit, kind of I mentioned the FTSE 100. So during 2025 AGM season, I think it's around just under half of the FTSE 100 have taken new remuneration policies to a shareholder vote. and of those, around 90% of proposed increases in quantum in some way, shape or form, with just around kind of 50% increase in incentive opportunities by at least 100% base salary. So kind of take from that significant number of companies suggesting putting through increases, and also some significant incentive increases going through there. Second trend is around kind of innovative incentive structures. So for several years, the UK companies, more than 75% of UK companies have operated what we call kind of a conventional incentive structure. So annual bonus alongside a performance share plan, with a performance share plan being a share award which vests after 3 years subject to performance metrics. And then if you're an executive director, you're lucky enough to have an additional 2-year holding period attached to that also. So that's been kind of typical state of play for several years. What we've seen over the last couple of years, and more so during the 2025 AGM season, is companies looking to introduce more innovative incentive structures which are better aligned to their business strategy and better aligned to their talent needs. And the most notable different innovative incentive structure has been what we call the long-term hybrid structure, which is ultimately a mix of performance share awards and restricted share awards, or RSUs. And restricted share awards are simply similar to the performance share awards, other than that they vest after 3 years subject to continued employment only, potentially with some underpins attached to them. And in terms of numbers, I think we're close to 20 companies now operating hybrid structures across the FTSE 350. So it's not kind of wholesale change, but definitely significantly more compared to where we were 4 years ago. And then the final trend that we've been seeing is a relaxation in the pay governance features of remuneration policies. So in particular, a relaxation in required bonus deferral. And what I mean by that is some companies are putting through proposals which ultimately state that where an executive director has met their shareholding guideline, be that 2 times salary or some other guideline, then once that's met, the executive is deemed to hold sufficient shares that they're aligned to shareholders, and therefore the bonus deferral requirement can be relaxed, whereby the required amount to be deferred is reduced, or it's waived entirely. So those are the 3 key trends. And in terms of investor reaction, actually we've seen some positive kind of reaction from shareholders. Particularly, shareholders have been sympathetic to companies that have used the kind of market competitiveness rationale particularly to compete on a global basis, and really that's come through in terms of the shareholder vote. So where say 3-4 years ago a change to incentive quantum could have attracted a vote of kind of in the 60%, we've seen that kind of vote come out at 80% plus. But there is a caveat to that, in that whilst there's kind of lots of change going on, I do believe that we could see some shareholder fatigue if we continue to see lots of change in terms of remuneration policies, and particularly I think shareholders are wary of the potential for pay ratcheting, where organisations continue to look for increases in quantum, particularly for those organisations who may not have such a strong argument in terms of that global market competitiveness piece. So kind of with that, I'll kind of just close my introduction and say that it's good to see, and it's a positive step forward in terms of a more open UK market in terms of executive remuneration. But what I would say is that ultimately investor and market sentiment continues to define what is considered acceptable. So if you are looking to put forward more significant changes to your remuneration policy, then as a first step in terms of positioning with shareholders, make sure you've got a strong, robust rationale as to why it supports your business strategy and why it supports your talent needs. And with that, I'll hand over to Carla. So kind of hopefully that's a good kind of scene setting in terms of what we've seen from the 2025 AGM season, more generally around policy reviews, but very interested to hear from Carla around how this is all kind of made to work from an implementation perspective.
Thanks, Gary. Really helpful to hear that sort of broader background and what you're seeing in terms of the policies and the support for those at AGM this year. Really interesting. I'm going to focus a little bit on some of the nuts and bolts we've seen in terms of the specific points that came out of the investor guidance that Gary mentioned and how they have been playing out and boiling down into the share plans. So the first theme I'm going to talk about is dilution. So dilution's probably been the biggest change we've had most conversation about following the investor guidelines updates with our clients. And just to step back to give a bit of background to check everyone has the latest information. So institutional investors have a limit on the number of shares that can be issued for share plans. And there used to be two limits, one being 10% for all employee awards and the other being 5% for executive plans over a 10-year period. And note that that's 10% in total, half of which could be used for executive plans. So that 5% limit has actually been removed from the guidance. So many companies have thought about whether it's appropriate to update their plan rules to remove that 5% limit and considered that. And we've worked through that with some clients. We've seen some companies take that to AGM to sort of have that increased flexibility on limits. Some of those clients were already battling headroom issues, so saw this and immediately jumped at the opportunity. Other clients have decided to retain the limit for now because they like that separation and that protection of what shares can be used for all employee plans and what shares can be used for executive awards. And some have just acknowledged it, but don't have headroom issues, are comfortable with the limits they've got. And others that are perhaps watching and seeing reactions to those companies that take this change first to AGM. So just to bring a couple of client stories to life, there's been a bit of a mix in terms of support we've seen. And obviously this change in some cases was voted alongside other changes in the rules, but this will give you a bit of a flavour. So one good news story, one client got 99% approval on their AGM update that included this change to remove the 5% limit. So good news story there. Another client had a very different experience and received pushback on this proposed change to the 10% limit. And they only received 70% approval for their LTIP that included this change. They believe that that was due to a misunderstanding about what the change actually meant, and they had to have conversations with institutional investors who had thought that that change would mean that the 10% would all go to executives now. Another client had approval to remove the 5% dilution limit. They were upfront and clear about removing that limit. They were around the 6% limit mark going into this change. Actually, they included notes emphasizing it wouldn't impact kind of existing levels and gave a lot of commentary around that to get their shareholders comfortable with that ahead of time. So mixed experience, both in terms of people taking the change altogether and then those that took the change, mixed results in terms of the outcome. I think a key point to note is that consultation was key. So ensuring that there's a good narrative going alongside that change to make sure it's well understood. For those of us that work with the institutional investor guidelines and, you know, we've followed this change, etc., it's almost seen as, you know, part of the day job. But for some shareholders voting on this, just seeing that change and removing that 5% limit would be a red flag. So making sure there's that commentary around it. Another point linked to dilution was that some of our AIM companies actually have enjoyed the increased flexibility. So AIM companies technically had more flexibility anyway, but they've actually seemed happier to use that discretion now and actually exercise the discretion they already had really, but they seem more confident based on these updated guidelines to actually use that as the market see it as more acceptable. A linked point on dilution is we've seen some discussion on the way we draft dilution limits and how they're calculated. So plan rules generally have been historically drafted in line with the investor guidelines so that dilution impact is measured when the shares are, when you commit to issue the shares. So that would be at the point of grant. there was some change in the language in the investor guidelines, which indicated that maybe this didn't need to be measured until the shares were actually issued later at vest or delivery. So there's been some conversation about whether it's appropriate to update plan rule drafting. Generally, we haven't seen companies take that change. Was it a deliberate change by the IAA? Was that just an unintended consequence of drafting? I think perhaps was the case, but just to kind of let you know that we did see that point come up. Another point in terms of the nitty-gritty bit that we've been seeing relates to the removal of the bonus cap. So this is more relevant to financial services companies, but the point can be more generally applied. So often plan rules are drafted with a limit provision within them, individual limits on awards. And it's our preference that that limit provision would cross-refer to any limit in the policy. So making it future-proofed. So if there's a change to limit in policy, it automatically will apply to the LTIP without also having to get the LTIP updated. But for some of our clients, that wasn't the case. They had hardwired limits in their LTIP plan rules. We didn't draft those plan rules originally. And so we've worked with them as they've updated their policy to also update their LTIP to cross-refer over to the policy so that it's kind of future-proofed and changes as the policy changes. I might just pause there and ask Gary, there's a couple of points I've covered there that he might have a few reflections on. So whilst we're on bonus cap, has your experience been that flexibility is useful, Gary, to cross-refer from the LTIP to the policy?
Absolutely, not just from the in terms of the bonus cap, but more generally where you've got a set of LTIP plan rules that have flexibility and kind of cross-reference a director's remuneration policy. What that then means is if you do change quantum within the remuneration policy, then the LTIP rules automatically flow, which is two things, right? One, it means that you don't need to go back to shareholders and get your plan rules reapproved for the re-established limit, but also it kind of helps from an administration perspective as well, because you're not having to update your plan rules. It's all kind of it's all succinct and linked. So I'm a big fan of flexibility when it comes to LTIP rules, and the greater the flexibility, the better. The caveat to that is where you've got the greater flexibility, then clearly from an executive remuneration perspective, you've got the director's remuneration policy, which governs the kind of limits in which you can grant awards to the executive directors. But having some form of kind of policy that sits below executive directors, which says, yes, the LTIP have these kind of limits, but this is the way we operate the LTIP for below board, is also useful just from a good governance perspective.
Fab. And on the point I mentioned on calculating dilution limits, have you seen anybody trying to make that change, or any recent updates from the IA on their views on this?
Absolutely, that point resonated with me, because likewise I've had clients ask exactly the same question, right? Which is, we've seen a simplification in the IA language around the calculation of dilution limits. Does this now mean that we don't calculate from date of grant, i.e. kind of promise to settle, but actually we calculate from vesting? And we actually clarified this with the Investment Association, who come back and said, no, it was ultimately a simplification of language. The intention is that you still calculate dilution from the point of grant. So from the point in which you grant an award and there's a commitment to issue that with new shares, then it should be included within your dilution calculation.
And I think that makes sense, because even if you chose not to calculate until vest, you wouldn't want any hidden surprises come delivery. Therefore, you already need to be tracking from grant. So I think it prevents any unnecessary surprises when you come to deliver, and yeah, makes sense. One of the other points that we saw changes to in the investor guidelines that's impacted some plan rule changes is the removal of the 42-day grant window, clarification that just needs to apply to executive directors. So we've seen again some different approaches to this in updates this year. So some have straight away removed that 42-day window and made it clear that that only needs to apply to executive director grants. Others that have decided it's not a significant enough change to update their rules for at this stage, but noting that when they do update their plan rules at the next opportunity, they are thinking about removing that. Others that have actually said they quite like the current timescales. That 42-day window gives them a safety net to make them sure, because even without the 42-day window, you need to make sure you're not granting a closed period. There's market abuse regulations to think about. So actually having that timetable in place is a safety net for those business as usual grants. My personal preference is that I'd like to up-to-date the rules to allow the flexibility, so to not have to comply for that 42-day window for people that aren't executive directors. But you know, in practice, if you want to stick to that timetable because it gives you that comfort that it complies with your other regulatory requirements, then having it there. But we always get those not business as usual grants, those off-cycle grants, where we're sometimes battling and looking for an excuse to override that 42-day window anyway. So for the population where we don't need to be subject to it, I think it could be helpful. Any thoughts on that 42-day window change, Gary?
I completely agree with that. I'm a big fan of having an annual calendar and kind of sticking to it as much as possible, because as you say, it just helps with that governance, and you don't want to trip yourself up into kind of granting in a closed period, for example. But equally, the fact that you've got that extra flexibility within the rules to grant outside that 42-day window for other employees who are not executive directors, it would be extremely helpful, not least because I have a number of conversations around whether or not it's considered exceptional, which is typically in the rules. So it'd stop those debates.
Yeah, and sometimes it's hard to argue that, you know, an all-employee ward is exceptional if you've just chosen to make it off-cycle, etc. So yes, I think that flexibility is helpful. Another smaller point we saw change was the removal of the 10-year life for all employee plans. And again, bit of background, all plans used to have a 10-year life, but it's been removed for all employee plans, still retained for executive plans. And I think this can be helpful again in some cases. So we have had some clients fall into a trap where their plan has been an evergreen arrangement, but the 10 years has expired ahead of their AGM where they plan to approve that. So then you've got this period of time that they're not able to grant. So again, removing this might be helpful. It will be a change that needs to go to shareholders. So some clients sort of tabling that for the next time the plan goes for approval. I think it is worth mentioning in practice that 10-year life, even if you remove it, it's sensible to review the plan at least every 10 years. So is it going to be fit for purpose in 15 years? Probably not. So just removing it doesn't mean you won't look at it, change it for that period, but not having to be stuck by that rigid 10-year time frame if it actually ends up being 10 years and 2 months, 10 years and 3 months because of the way your AGM cycle falls or your grant cycle falls. Again, that flexibility might be helpful. Any thoughts on that one, Gary?
Absolutely. I mean, I agree with everything you've said there, particularly around the kind of good housekeeping. And normally 9 times out of 10, we see a kind of a change in rules within that 10-year period where we need to kind of update plan rules anyway, right? I mean, if you look over the last 10 years, you've had the kind of malus and clawback come in, you've had the kind of the overarching discretion where inevitably there's been changes to plan rules anyway. But I do like the fact that you're not kind of stuck to that 10-year period, because as you said, it sometimes can catch companies out in terms of just being just outside that window and then forcing an approval for new shareholder rules at the previous AGM. And also, I think it's quite neat to align the approval of share plan rules with your next remuneration policy too, because they kind of fit together. So it provides more ability to do that without having to kind of do it, or being forced to do it too early.
Yeah, makes sense. I think one of the key themes we've seen, I referred to it, was consultation. So I think with all of these points, our clients seem to be having more success where they've had more consultation, they've got a good commentary narrative. Has that been your experience as well?
Yeah, I mean, absolutely. I think it's been a key theme of the last 2 AGM seasons, particularly with the remuneration policy changes, kind of early consultation with shareholders, not just kind of setting out what you're going to do in the director's remuneration report, has been primary reason for me as to why we've seen an uptick in kind of the the shareholder voting, because you've got that opportunity to kind of sit in front of shareholders and explain exactly why you feel that the proposed structure is right for your business, right for your talent strategy, and then they get a voice too. So what you normally find is your starting position isn't always the end position, because you've got kind of different shareholder perspectives to take into account, and ultimately there's some iteration involved in that. So if you were to go straight into the director's remuneration report without having that consultation, then you open yourself up to scrutiny when it's probably too late to then react to it and appease shareholders.
Sure. I think another theme that we've probably both drawn out as we've been chatting is flexibility. So both of us have referred to flexibility being really important, really useful. In your view, have you ever had a scenario, if we look at it both ways, one where flexibility has been really useful, and perhaps on the flip side, have you ever had a problem where the plan rules are so flexible that it causes you issues from kind of putting that into a policy and making clear that the flexibility in the plan rules won't apply to the executive directors, etc.?
Yeah, so there's a couple of examples. Yeah, I've got a couple of examples there. So one where we made a change to the remuneration policy in terms of incentive quantum, actually increase the incentive quantum, and then ultimately the shareholder plan rules, it was kind of like, oh, we need to check that too, and it was kind of running kind of quite close to the clock in terms of being able to get the notice of AGM prepared. But fortunately the plan rules were aligned to the remuneration policy, so we didn't actually have to kind of worry about it. So it was one of those few moments, and we sold it as yep, we're all good, it's fine. One where the flexibility has been a little bit of a concern was around the malus and clawback. So not that we were looking to operate malus and clawback, more that we were just kind of wanting to understand, okay, so we've got malus and clawback, a time period that applies to the executive directors, but within the remuneration policy, but actually the period that applied in the rules was longer than the policy itself. So then you're in the predicament where other employees have got a longer malus and clawback period, whereas then the executive directors, do you go to the policy, do you go to the rules? Now your REMCO might say, we'll point to the rules because that's the more kind of onerous approach, and I could see an executive director saying, no, I want to be governed by the policy because that's more favourable to me. So you just want to avoid those situations. Yeah,
definitely, as lawyers, usually that helpful line that says something like, if in the event of dispute, the plan rules take precedence. Hope that you have that line in there. Yeah, I think flexibility in practice for us as well has been useful, particularly I say in periods of economic uncertainty, as if that's a one-off, but we feel like we've been in periods of economic uncertainty for quite a while now, both the highs and the lows, and how they've impacted share plans. I think the flexibility in the rules that we found really useful are your overriding discretions at vest, so making sure you've got that ability to adjust the vesting outcome, so that the formula might not be the most appropriate payout. Actually, depending on the share price at the time of grant or how the company's actually done over the vesting period, does that make sense? Does that feel right to pay out at that level? And having that ability to adjust up and down, actually, the vesting outcome. Also, the flexibility to delay grant in your timetable, because we have had scenarios where it might not be appropriate to grant because of sudden share price changes, a bit longer to work out what the right grant levels are based on current share price, market values, etc. And having the ability to run your performance period can still be running even though your grant date is delayed later, so referring back to the start of the performance year even though your grant date is delayed. So yeah, flexibility on that, flexibility on the vesting period, so if you do end up with a delayed grant, you've got the ability to have a shorter vest, because you still might want it to coincide with that 3-year cycle, even if you granted a bit later, but it will still vest following the 3-year performance period. So yeah, there's some of the useful bits of flexibility that we're hanging our hat on at times of variation and different client circumstances.
I think that's right. I think, and the kind of the ones that you mentioned at the end around the kind of curtailed performance period, and kind of if you happen to grant late, you still want it to kind of kick out in the normal vesting time frame, if you like. I've seen that a number of times where for one reason or another there's been a delayed grant, and then you don't want to be locked into that 3-year period from grant. You want to be able to kind of vest at the normal time. I think the final piece on flexibility that just popped into my head is around is around kind of recruitment awards and particularly buyout awards, because what we find a lot of the time is the share plan rules might not accommodate the ability to then grant a buyout award. So then what that then means is you're relying on the listing rules provision to be able to kind of grant outside of it. But there's a quirk there about kind of saying in exceptional circumstances. So then you're back into that argument around, well, every time you recruit a new executive, is that really an exceptional circumstance? So to avoid that altogether, just make sure your plan rules are flexible enough to handle buyout awards in the first place. I think is the takeaway there.
Yeah,
well, thank
really.
you. Thank you for that sort of tour d'horizon of what you're seeing out there in the marketplace in this AGM season. You mentioned there are a couple of themes that are cropping up. One, flexibility. I suppose that is really part of a broader theme of, are we seeing sort of a deregulation or re-regulation, and have we actually reached the sort of the high point, the high watermark of regulation? Because certainly we've been through a decade or so where there seemed to be ever more complexity and regulations coming in from different angles. Do you think we've actually reached that high watermark yet?
Yeah, I think yes. I think we have seen indications of regulation softening, or a trend to allow more bespokeness, more holisticness, thinking about the bigger picture, the company's circumstances. As Gary referred to earlier, actually an appetite and an acceptance to accept narratives that describe the need for market competitiveness. So I think a realization actually prescriptiveness and regulation isn't sometimes helpful in the sphere that we work in, and actually doesn't give the outcomes for incentives that we want. So yeah, I think it's a balance. I think perhaps we will see some more, one eye on what Trump's doing in terms of economics, but I think Europe perhaps opening up as a more attractive market as some of that kind of regulation reduces, but still creating a safe and predictable environment, perhaps when compared with unmeasurable quantum across the pond. Yeah.
And yeah, I agree with Carla. Just to add that, I mean, my thoughts on regulation is I'm for regulation where it supports better business practices, right? Ultimately, and that's the place where I think the UK is trying to get to. So yes, I think we've kind of hit the high point, but it kind of comes back to my earlier comment, which is regulation or not, ultimately investor sentiment is going to define what's acceptable. So that's the bigger issue here in terms of having those conversations with shareholders as to, certainly from an executive pay perspective, as to why what you're trying to kind of land, support your business, is aligned with shareholder kind of shareholder sentiment, shareholder views, kind of shareholder returns, and then ultimately addresses your talent needs.
Yeah, I think I saw a stat, you correct me if it's wrong, Gary, that there were less shareholder revolts last year, so less of your sort of 20% against policies, but then still some significant votes against particular points taken to AGM.
Yeah,
so
absolutely, and like I said, we've kind of we've seen shareholders be more accepting to quantum increases, more innovative structures, as I say, particularly around this kind of US global talent argument, but it's definitely not an open door and a green light. And if you push the envelope too much, then shareholders will scrutinise it, and there will be a kind of a weakened level of support there inevitably.
Yeah, just a reminder to the audience that to keep the questions coming. I've got one more. Gary, you sort of mentioned that you'd seen a sort of uptick in hybrid schemes. I think you said like 23 out of the FTSE, out of 350 in the FTSE 350. So do you think that is a trend that will continue to creep up, or do you think it is always going to be a real minority sport?
Yeah, so I think we're around 20 at the moment, give or take, and I don't see hybrid structures becoming replacing the conventional structures, so becoming the majority. I still think it'll be a minority, but ultimately I can see over the next 1-2 years more hybrid structures being introduced. So just kind of as kind of background, the majority of those companies that have introduced hybrid structures either last year or kind of this AGM season have done so for kind of a US talent argument. So hybrid structures are very common across the US, but as I say, kind of more seldomly operated in the UK. So as part of that competition, being able to compete against US organisations, that's been the kind of driver for hybrid structures, and shareholders have generally been sympathetic to that argument, right? But what has muddied the waters a little bit has been that, as well as the introduction of the hybrid structure, we've also then seen those organisations increase the incentive quantum too, because they've said it's not just the structure, but it's also the level of quantum at play that we need to address in order to compete against the US. And that's been kind of played out in a couple of ways. Either there's been a kind of an actual absolute increase to the LTIP opportunity say, or what we've seen is when converting the kind of PSP element into the restricted share unit, they haven't applied the 50% best practice discount. So ultimately what that's meant is, while shareholders are sympathetic to the structure itself, they've then received a weakened level of support because they've gone against best practice in terms of the quantum. So that's muddied it a little bit. In terms of rationale for hybrid, if you park the US talent argument, I do think there's kind of other rationale for introducing hybrid. So if, for example, organisations that operate in cyclical industries such as kind of oil and gas, mining, real estate, then for me there's a strategic argument there that says, if you introduce hybrid, what that does is provide some certainty of reward through the restricted share element throughout that cycle. So kind of supports retention, supports kind of long-term stewardship, and then the PSP element is there to kind of really incentivize the executives to kind of drive out performance and beat the cycle ultimately. So I think there's definitely strategic rationale for kind of companies within a cyclical industry, and then also kind of consumer facing industries, right? Kind of the industry there can kind of turn on its head quite quickly, is very susceptible to kind of global economic conditions. So ultimately, again, you can see how a hybrid structure would work there, because it provides that kind of level of certainty when you're kind of operating in such a kind of uncertain environment. So I do feel that there's other strategic rationale out there, and I do feel that organisations will be probably looking at this moment in time. So I can see a little bit more of an uptake, and personally, I'd love to see kind of hybrid structures introduced over the next couple of years, which is outside of the typical kind of US talent play argument that we've seen, and there's more of a kind of a strategic rationale linked to kind of industry sector or kind of business strategy.
Yeah, I think that's really interesting, and I think it's worth noting that what Gary's generally describing is at the executive level. The plan rules are generally drafted flexibly to be able to. So most LTIPs are drafted to be able to make hybrid awards. You can make performance-based or non-performance-based awards under them. That would be our preference with drafting. So you don't need to have a separate plan, one dealing with performance awards, one dealing with not. And I think below the executive level, it's worth mentioning that this is quite common, that more pay will be made up of the time-based RSU and some performance share awards, or a combination of both. So I think that kind of concept of having both together, it's just obviously an executive level whether it's appropriate or not to have some just for turning up versus driving performance. And I think that's an interesting balance, because from a rationale perspective as well, I always think, well, performance awards are great for driving performance, but then managing that with not driving risk-taking behaviour. And, you know, we saw with the financial crash, you know, great performance, mega payouts, but then the aptitude for risk is higher. So actually your RSUs provide that balance for some remuneration is going to be paid without excessive risk-taking driving performance.
Okay, I have one question from the audience here, which is from Lynette Jacobs from Vincent Masons, and she wants to get some clarification on whether the Investment Association removal of the 10-year life applies only to all employee plans.
My understanding is your broad-based employee plans, so it doesn't need to be an all-employee plan in terms of a UK SIP, for example, where every employee is invited. But I can go back and double check the wording of that as a follow-up.
Okay. Well, we're actually, gosh, we're running out of time now. So any questions that are not addressed, we will send those to you for you to reply to the questioners individually. But I think we're probably going to start to draw proceedings to a close now. And I'd really like to thank our two speakers, Carla Walsham and Gary Faraday. I mean, Gary's, I know, in the middle of a conference somewhere, and so special thanks for you for coming out of that. And just to mention briefly the upcoming events that are taking place here. After I have thanked our generous sponsors from both the FS Club and the Esop Centre, we've got, and a reminder that we should go to the Esop website centre, and I'm sure many of you have already signed up for Newspad, our excellent monthly publication. If not, please do so. The forthcoming events, Tuesday the 1st, actually an in-person event on the topical topic of AI and can it survive regulation, followed on Wednesday the 9th of July about crumbling capital and the fragile public spending foundations that need rethinking. That's true for almost every country in the Western world at the moment. Followed on Thursday with an update on EU financial services regulatory, the agenda from the EU. So finally, again, to thank our two speakers, and thank you, the audience, for paying attention and asking questions. And we'll see you at the autumn version of the Esop Sofa. So thanks very much indeed.